Welcome back, my friends. As you all know by now, car prices are higher than ever. In fact, I would go so far as to say that they have become nearly unaffordable for many people. And we all have heard the various reasons for rising car prices. Inflation, supply chain issues, and higher interest rates for buyers who need a loan to buy a car. And, of course, all of that is true. But automakers and car dealers are also experiencing record profits. That is especially true for new vehicles because as demand is outpacing supply. And supply chain issues and other production problems have throttled supply. The car industry as a whole seems to be hanging their hat on pent-up demand as a driving force for earnings from now on. But at the same time, there are signs that demand could be weakening. Are car prices too high? The average price of a new car purchase is now more than $48,000. That is up from $39,000 just 2 years ago. The price of new cars and trucks rose % in 2022, according to a report by the Bureau of Labor Statistics. Why did this number rise so much in just 2 years? And what should we expect in the future? With prices this high, can average Americans even afford a car these days? This video takes a closer look at car prices in the United States. What does this mean for the middle class? What does this mean for the future of the car industry? And, what does this mean for the future of the United States? But, before we get into all of that, please hit the like button and leave a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos. Car prices seem to have gone nowhere but up since the start of the pandemic. As you all know, inflation is raging in most countries of the world. Central banks are raising interest rates to fight inflation. But rising inflation and interest rates are stoking fears of a coming recession. Not surprisingly, Wall Street analysts are now closely watching Q3 earnings results. That includes forward guidance from the public car makers and sellers. Many are suspecting that they will soon see signs that car buyer demand may be softening. Auto sentiment is very poor. We get it. Higher rates, still high prices, low consumer confidence, RBC Capital Markets analyst Joseph Spack wrote in an investor note last week. A potential recession and European energy risk does not make autos a friendly place, Spack continued. Third quarter earnings should mostly be fine, with the focus being on company commentary and guidance revisions, Spack added. Spack also noted that he expects revenue and earnings estimates for 2023 to move materially lower. RBC is not the only Wall Street investment bank that expects things to change in the auto industry. It is widely expected that demand could soften quickly and today's supply chain issues will be resolved. The overall automotive sector in 2023 is deteriorating fast so that demand destruction seems inevitable at a time when supply is improving, Spack added. Most Wall Street analysts expect profits to be cut in half at US and European car makers in 2023. We expect weakening demand leads to an oversupply of vehicles, UBS analyst Patrick Hummel told investors last week. Hummel downgraded shares of both General Motors and Ford Motor. Within 3 to 6 months the auto industry will be in oversupply, Hummel noted. That will put an abrupt end to the unprecedented pricing power and profit margins for the automakers in the past 3 years, Hummel stated. Hummel downgraded shares of Ford to sell from neutral. He also downgrades shares of GM to neutral from buy. Shares in both General Motors and Ford fell about 8% following Hummel's downgrades. Maybe you recall from last month that Ford experienced parts shortages that affected 45,000 vehicles. And these vehicles were mostly high-margin pickups and SUVs. And you probably also remember that Ford booked an extra $1 billion for unexpected supplier costs in Q3. So far, we have not heard that General Motors had any similar problem. General Motors is preparing for increased demand for its vehicles next year, said GM CEO Mary Barra. But we want to be prepared regardless of the environment to continue investing in its electric vehicle plans, Barra added. GM is scheduled to report Q3 earnings before markets open on Tuesday. Ford will report Q3 earnings on Wednesday after the close of the markets. Probably the first sign of softening demand came last month when CarMax fueled Wall Street analyst concerns last month by reporting its biggest earnings misses ever. CarMax reported that same-store unit sales declined by 8.3% in its Q2 that ended on August 31st. Wholesale prices for dealer auctions have declined for 4 consecutive months, said Cox Automotive. That could be the first sign that car buyers are no longer prepared to pay near record prices. The sentiment for franchise dealers' third-quarter earnings is the most negative we have encountered since the pandemic, said J.P. Morgan analyst Rajat Gupta. The sector is not immune to ongoing macro challenges, and we are dialing back our estimates for 2023 materially to reflect a mild recession and hitting a new normal by 2025, Gupta wrote in an investor note. But new car availability is still somewhat low, and that could continue to support higher prices for new cars. Even if there is an economic downturn, sales could still increase, though profits would be expected to tighten, Gupta noted. Lithia Automotive reported its highest Q3 revenue and earnings in its entire company history. Lithia's third quarter may be the last of the really good gross profit per unit quarter of this cycle, said Morgan Stanley analyst Adam Jonas. CarMax's weak fiscal Q2 results set the tone for the used market, added Jonas. And we believe Lithia's Q3 miss should set the pattern for the franchise players, Jonas said in an investor note Wednesday. Other major car dealers have yet to report Q3 earnings. Group 1 Automotive on October 26, AutoNation on October 27, Asbury Automotive Group on October 27, and Sonic Automotive on October 27. Tier 1 suppliers of automotive parts to carmakers have experienced substantial cost increases during the pandemic. Wall Street analysts expect declining revenue and profit from Tier 1 parts suppliers. Specifically, that means ongoing growth this year and single-digit growth in 2023. Tier 2 suppliers, which sell smaller parts to Tier 1 suppliers, seem to be under the most pressure. Tier 2 suppliers have experienced lower volumes, increased costs, and labor shortages. A significant number of suppliers are going back to the original equipment manufacturers asking for support, said KPMG analyst Gary Silberg. Not only just for them but for their suppliers. It's a dance basically that everyone's doing all the time, Silberg said. They don't have a lot of leverage as the problem. It's been a very tough 18 months. Silberg also noted. A survey conducted by KPMG found that 86% of CEOs in the auto space expect a recession in the next year. The good news is that the recession is expected to be mild and short. We expect auto suppliers to report Q3 results in line with Wall Street's expectations, said Deutsche Bank analyst Emmanuel Rosner. We favor auto parts suppliers over automakers into next year, Rosner added. But we see potential earnings downside risk from smaller suppliers such as American Axle and Manufacturing and Dana Incorporated, Rosner also noted. As I am sure you already know, new vehicle prices hit an all-time record high in August. This follows strong demand despite rising interest rates. Car prices have skyrocketed in the last 2 years. But, what do you think? Will the shrinking wealth of the middle class make cars unaffordable? Please hit the like button and leave a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.